Now we're going to look at accounts receivable transactions. Credit sales are when the business sells now and delivers inventory goods now, but receives payment later. The business recognizes the customer as an accounts receivable. Sales returns are when the accounts receivable, that is the customer, returns inventory to the business. This will decrease amount owed by the accounts receivable. For our course, we do not record cash refunds. Receipts from accounts receivable is when the business receives payment from the accounts receivable for an amount owed. A discount expense may be given to the accounts receivable if payment is received within the discount period. The credit terms of 10/7 and/30 means 10% discount is given if payment is received from the accounts receivable within 7 days of sale. Full payment is required within 30 days. Let us look at the first transaction. Choco Treats is a business that sells chocolate products. Markup of 100% is applied to all inventory. So that's us, Choco Treats. That's our business, and this time we can see that Choco Treats is written right at the top, which means we are the supplier and we are making a sale to a customer, and we can see that our customer here is Sweet Shop. So since this is a sale that we have made, Choco Treats has made, the source document that is used to verify this transaction is what we call a sales invoice. Now to describe this transaction, we are going to address the who, what, and how. So Choco Treats, that's our business, has made a sale of inventory of 84 boxes, totaling to 1,260 plus GST, or you could also say 1,386 including GST. That's fine as well. Okay, so Choco Treats has made a sale of inventory of 84 boxes totaling to $1,260 plus GST to Sweet Shop, which is the customer, on credit, and that's explaining how this sale was made. To record the transaction in the general journal, we're going to start off with the date, and here we have 20th of June. Now we know this is a credit transaction, and therefore the customer owes the business money. So there's no cash transaction here, no bank, but instead we recognize an accounts receivable, which is Sweet Shop. The analysis would be an accounts receivable is an asset because we're expecting to receive an inflow of cash in the future. So this is an asset, debit nature, and here we can see that our accounts receivable owes us more, and it increases on the debit side. Total amount $1,386, and the accounts receivable owes us because of a sale. The sale is a revenue, credit going up. That means we're going to record the sale on the credit side, and the sale is for the amount of $1,260. The sale also has GST. Any GST liability owing to the ATO will increase because this is a GST on sale. And that's $126. We have sold inventory. So we need to recognize the cost price of the inventory that was sold, and that's an asset, debit. The inventory is going down because we have just made this sale. So inventory going out. We need to work out the cost price of the inventory that was sold. To do that, we look at the markup 100% that we are told, and we're going to do this calculation right at the bottom here. Since the markup was 100%, so that means the cost 100% plus markup 100% will give us selling price that is worked out 200% convert it to decimal, that is a 2. And that means to work out the cost price, we need to take the selling price of $1,260. Take the amount without GST, and you divide that by 2. That will give us a cost price of $630. And that, guys, is the amount we are going to be entering for the inventory on the credit side, because inventory is decreasing. And we now recognize the cost of sales, which is an expense, debit going up, 630 on the debit side. Next, we're going to have a look at a sales return. This source document here was issued by us, Choco Treats, as the supplier. That means we are issuing this source document to Sweet Shop, who is our customer. Since we can see that this is a credit note, and every time we see a credit note, we know that some sort of a return of inventory has occurred. Since this is a document that was issued by us to the customer, this transaction involves the customer, we can therefore conclude that this is a sales return. The source document that is used to verify a sales return is a credit note. Now, to describe this transaction, we will address the who, what, and how. So in this case here, Sweet Shop as the customer has made a sales return of 4 boxes of inventory to the business, Choco Treats, for a total credit refund of $66. So we can see that we have addressed the who, that would be Sweet Shop and the business. We've also addressed the what, which is the sales return of the 4 boxes totaling to $66. I would add here including GST as well. And we have specifically mentioned that there was a credit refund as well. So that's a description of the transaction. Now let's look at recording the transaction. So starting with the date, June 21st. So since this is a credit transaction, a credit refund to be specific, it does not affect the bank. Instead, it affects the accounts receivable, specifically Sweet Shop. Accounts receivable is an asset that is a debit in nature. And since we are giving this credit refund to the customer, any amount that the accounts receivable was owing goes down, it decreases. So this is a debit going down, and therefore we would record the amount that was refunded, total amount, on the credit side. So that would be $66. This was a sales return. Now, sales return is what we call a negative revenue. Since the revenue is of credit nature, a negative revenue would therefore be a debit nature. We are recognizing that there was an increase in the sales return, and so on the debit side, we are recording $60. And the GST clearing, reversal of the GST from the original sale, it will also be a $6 on the debit side. The customer, Sweet Shop, has returned inventory to the business. So in other words, as the business, we have received the inventory back, and it's an asset debit going up. Oh, we need to work out the cost price again using the markup that we were given earlier. And let's do the calculation quickly on the side. Since we know it was a markup of 100%, I'm going to show the calculations again. We assume cost price 100% plus a markup of 100%. That means the selling price is made up of 200%. And if we convert that into a decimal, it would be 2.0. To work out the cost price, we take the selling price of $60 without GST, divide that by this special decimal here, 2, and that will give us a cost price of $30. And that is what we are going to be recording in our journal here in the inventory entry. So inventory asset debit going up, so on the debit side we will record the $30. The cost of sales, it's an expense debit going down because we need to reverse the cost of sales that was previously increased when we first made the sale. But since this is a sales return, the cost of sales is therefore decreasing by the cost price of $30. Finally, we're going to have a look at a receipt of payment from the accounts receivable. So we can see here that there are a couple of source documents here that can be used to prove that we have received cash from the accounts receivable. So when we receive cash from the accounts receivable, anytime we receive cash, it's quite common for businesses to issue a cash receipt. And that's to acknowledge that cash has been received, in this case from Sweet Shop, our customer. And we have received $1,188 for the balance owing. We'll work out that amount very shortly. We can also see here that there's a funds transfer report that we have in our records. We can see that it also shows that we have received cash from Sweet Shop was for the amount $1,188, and it was a payment for a balance owing. Okay, so let's have a quick look at the credit terms that we have given, the business has given to the customer Sweet Shop. To find the credit terms, we look at the sales invoice, which is what we have looked at earlier, and we can see in the sales invoice, here we go, the terms were 10/7 and /30. So here we have here 10/7 and /30. That means if payment is made within 7 days, okay, so we will get 10% discount for the payment that has been made within 7 days. Regardless, the full payment needs to be received within 30 days. Now let's check for question B, was the payment received within the discount period? So let's look again in the original sales invoice. We can see that the sale was made on the 20th of June. Now this payment that we are now receiving is on the 22nd of June. So definitely within the 7 days that we have given as a discount period, and so the customer will definitely be given that 10%. There we go, just gonna highlight that. So now we're going to record this transaction in the general journal. Since we know very well that we have received the cash, whenever we receive cash, we know that definitely there is a bank entry. So bank asset debit, and since we are receiving cash, it is going up, and the amount will be recorded on the debit side. Now let's see if we can get the amount right away, and yes, we can see here that we have in the funds transfer report, it shows here that we have received $1,188, and the cash receipt that we have issued as well, we have issued a receipt for $1,188. So that is the amount that we know for sure has hit the bank. Now who did we receive this cash from? And it's none other than our accounts receivable, Sweet Shop. So accounts receivable, it's an asset debit. Since they have repaid us whatever they've owed, any amount that was owing goes down, so they owe us less. So that amount will be here recorded on the credit side. Now, to work out how much the accounts receivable owed us, and that's basically the amount that they were needing to settle without counting to the discount for starters, we can see that when we made the credit sale, they owed us, the customer owed us 1,386. And then the customer made a sales return, and so we had to give a credit refund of $66. So basically, the accounts receivable balance was 1,386 minus 66, and that will give us a balance of 1,320 that was required to be settled. Now, remembering that we did offer the 10% discount because it was paid within 7 days. And that was a discount of 10% multiplied by the balance owing, 1,320, and that gives us a discount expense of 132. Okay, so back to our general journals here. Our accounts receivable, Sweet Shop has settled their debt, and so their amount owing, or their debt, has decreased by 1,320 as we have calculated below. Now we have given them a discount expense, and that is why we are recognizing that we have obviously lost some benefits here because of that expense. We are recognizing an increase in the expense, and that will be recorded on the debit side. Now let's check, and we can see here that the total of our debits, 1188 plus 132, that definitely equals to the total on our credit side, 1320. So we know we have done our journal correctly.